I'm John Hanna for CDTV.net here in New York City, and we have Louis Straney joining us from Lexington, Kentucky. I believe you're traveling, sir, right?
I am, John, but it's a pleasure to be here. Thank you.
Oh, thank you. Where's your base at?
Santa Fe, New Mexico is my home, and I work out of Santa Fe and travel not only around the U.S., but outside the U.S. borders as well for cases.
Oh, really? And this is all related to the stock market, securities?
It's all related to either my research on financial crimes or my career as an expert witness and consultant for securities litigation.
Nice, nice. So, what we heard a little bit of background. Can you tell us a little bit more about your background?
I started in the financial services in 1980. The stock market was around 770 when I first became a financial consultant, and short-term interest rates were in the double digits at the time, so that ages me a bit. But I started in 1980 and spent my entire career in senior management with basically one firm, and I retired in 2004. And in 2004, I joined a business school and ran a risk management clinic and helped in curriculum development around financial services. And then in 2007, I developed this interest in research on my own and providing expert testimony consulting for securities litigation. And I've been doing that since 2007.
Okay. Well, before we go into your book, I just wanted to ask you this question: is there more litigation now or cases now with regards to financial fraud or securities fraud as opposed to 10 years ago?
Unquestionably, there's more litigation, but it doesn't mean there's more fraud or misconduct. I think there's more awareness because of people like Alan Stanford or even Bernie Madoff probably brought more attention to the issue. So there's more litigation, but probably at least the same level of misconduct as we've had in the past.
Okay. Well, let's go into your book now. Tell us about your book, the name and the title of the book.
Actually, I've done three books in and around the same topics. The first book is used for just training professional investigators and fraud examiners, and that's just called Securities Fraud. The second is called Securities Fraud Detection, Prevention, and Control, and that's the publisher is John Wiley and Sons, based in Hoboken, and that's used in a lot of colleges and law schools for training business students and law students, plus it's good for the general reader as well. And then my most recent was released last fall, and it's called Loss Recovery, Investor's Guide to Loss Recovery and Rights, Mediation, Arbitration, and Other Strategies. So really two books on securities fraud, how to detect and prevent it, and then the last one on loss recovery. If you weren't successful in preventing it and you've been victimized, how you might recover your losses.
We got the Madoff, we got the MF Global, and then we have the Merrill Lynch, Lehman Brothers, and the other one, like you mentioned earlier. So, what are the other things that people don't hear about?
Well, I think that there's widespread misconduct through unregistered so-called advisors working with unregistered firms all across the nation. You certainly hear about the troubles at Lehman or Bear Stearns or Merrill Lynch and other firms, but some of these things that happen in someone's backyard isn't always given the same media coverage. There are substantial losses in many cases, and can be in the tens of millions, but for whatever reason are not given the same visibility, where a person who has virtually no regulatory oversight sets up shop, becomes a member of the community, and then takes advantage of that position to steal investors' monies. So that's the things that you don't read about, and they're just as dangerous as the things that are front-page news.
Do you have an example or case study that's been convicted, and what happened with the people trying to recover money
Hmm.
from that particular fraud?
Well, there was a case of an individual in Texas by the name of George Hudgens who supposedly was investing in the futures markets, and he was soliciting business from members in his community. And many people were connected to the church. In fact, church leaders were not only investors, but they helped him solicit other investors. Mr. Hudgens lost in the neighborhood of 25 to 30 million dollars, really based on the investors in a very small Texas community that knew him well. Many of them attended his church. They had a lot in common with him. They had reasons to place their trust in him, and it certainly all exploded. He is now serving a prison sentence and will serve a lengthy prison sentence. And for the most part, most investors are left without any recovery options whatsoever. The only chance that they have is that if he cleared trades through another organization and they ignored the red flags and the misconduct, they have some liability. So there is some hope for investors using some of the resources that Hudgens used in his illegal activity. But basically, he stole the money from the investor, used it for his own private travel, homes, cars, aircraft, you name it, and there's very limited options. When you have fraud at this level, a lot of money is consumed. As with Madoff, there was a lot of money that went out of the Madoff firm, and it was used in his personal lifestyle and the personal lifestyle of the people who work for him. So there's not much recovery in cases like that. It's consumed.
Okay, so I wanted to get the listeners to get the sense of you gotta look out for your money. I mean, you've saved that money, you've accumulated that money or wealth, and you gotta make sure that you do your own due diligence, do the research and all that stuff because, as you heard already, it's almost a lost cause, right? Of trying to recover money from this kind of situations.
Even in the best case scenario, the recovery options are very limited. You're absolutely right, John. It's much better to prevent it or to discover it very early than it is to go in after the fact, 2 or 3 years after the fraud has taken place, and try to hire an attorney, use experts, do a forensic analysis, and then try to be made whole. And for the most part, it's very difficult to be made whole.
Okay. Let's try to look at the what are the ways to prevent? Where do people need to go? Is there a website, a number for people to call if somebody approaches them and say, you know what, I got this an investment that's gonna give you 3 or 5% just to make it more. I think that it's what people are saying now. They try to make it more realistic as opposed to promising them 100, 300% return.
Right, there's probably people that are drawn to the 100 or 300%, but for the most part, the effective schemes, Madoff, for example, was offering slightly above market returns for a period of years in the 10 to say 14% range. That is certainly well above the market, but it wasn't to the level that it would get, the suspicions up of the typical investor. They just thought he was a very smart guy and sort of knew how to do things. So yes, if someone approaches you with an investment proposal, one of the first things that I would do is determine whether or not they are registered to do business in that state and their business is registered to do business in that state. Now, that's not to say that you check with the Better Business Bureau or the local Chamber of Commerce. That's really not registered. When you sell investments, you must be a registered person with a number of regulatory agencies who provide oversight. Now, often it's said, if you want to check on someone, go to the computer. You don't have to go to the computer. You can use your state securities regulator and determine whether or not, first, that individual is registered, and secondly, if the firm is registered to do business. If there's no oversight, there should be no investment. It's that simple. If you don't have ready access to the contact information for your state securities agency, I'd suggest calling a number 202-737-0900. That's the North American Securities Administrators Association. So you can just tell them your state of residence, and they'll give you the contact information. So that's a really good place to start. Determine registration. If they're not registered through a regulatory authority, then just walk away from it.
I'm thinking of before you write the check with your state registered securities.
That is a great byline.
I still have to like polish it up a little bit, but if I can trademark it, right? It makes sense, right? Before you write the check the securities industries.
Absolutely.
Where can people find you, a website, or buy the book? Okay,
my books are sold through all major booksellers, both in hard copy and electronic format, whether it's Amazon or Barnes & Noble, even overseas at Book Depository, sold in Canada at Chapters Indigo. So you'll find my books sold both in hard and electronic copy all over the world. My website is securitiesfraudresearch.org. That's securitiesfraudresearch.org. It has a encapsulation not only of my books, but some of the training that I've been doing and some things in the news that you might want to be aware of.
Awesome. That's Louis Straney joining us from Lexington, Kentucky, traveling right now. And I'm John Hanna for CDTV.net in New York City.